Here you go again, always me. All the things you say, none of it comes true. Met with a guy in LA. Good for you, it's all about
Life is an illusion, can't you see that love is everywhere? Step into the confusion, can't you hear the sound that's in the air?
It's rock and roll. 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 It's rock and roll.
And now for something completely different.
It's a rich fast world.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts, presented by RIA Advisors.
Hey, good morning and welcome to the Wednesday edition of The Real Investment Show. I'm your host, Lance Roberts, and of course, it's hump day as we start kind of plowing through the last few days of July. Going to get into the heat of it, right? August coming up, and that's one of the hotter months of the year, but for the markets, tends to be not as hot. So, we've talked about this rally that we've had now over the last several weeks. It's been good. And yesterday we had earnings from both Microsoft and Google, both missing earnings estimates and revenues. So again, if you take a look at Microsoft, really kind of missing on their cloud growth side as well. That certainly should be some concern for a company like Amazon, whose big bulk of revenue has been coming out of the AWS side of theirs on the cloud storage business as well. But that's not really the case today. And one thing that we've talked about here for a while is that what we're looking for to determine if stocks are kind of approaching a bottom. And again, there's a lot of stocks that potentially have more downside risk to them, right? Walmart was a good example of that. Missing estimates, stock was down pretty sharply yesterday. But there's a lot of companies that have already been beaten down a good bit. And we've talked about before is that part of what we will see in the markets is when companies begin to miss earnings and, have poor guidance, et cetera, but the stock doesn't respond negatively to the news, right? The stock either kind of holds in there flat or rallies. That might suggest, I'm not saying it's an absolute case, but that might suggest that stocks may have priced in a lot of the bad news already. And that may be the case here with Apple, with both Microsoft and Google. Both those stocks missed yesterday on earnings estimates. Both stocks are trading higher this morning. Now, the whole market is also trading higher because of that. Obviously, two very big weights in the NASDAQ and the S&P. So this morning, futures are pointing up. Dow's up about 117 points, but the NASDAQ's up well over 1% this morning because of Microsoft and Google. The S&P is also up over 1% this morning, set to open at the open. So again, that may be signaling here, and we'll talk about this a little bit more in the show today, that maybe we've priced in some of the bad news, right? That maybe estimates have gotten drilled down to the part where companies have, even though they're bad, they're not as bad as expected. We saw that with Netflix as well. They lost another million subscribers. Stock rallies because they lost 1 million subscribers because expectations were they were supposed to lose 2 million. right? So again, that we're seeing that a bit of rally here today. Now, the other side of good news here is what we've been talking about here for the last couple of days. The market has been coming back down after we kind of had this nice rally, got above the 50-day moving average, broke out of that downtrend. What we said was would be very important for the markets here is to pull back and test that 50-day moving average, not breaking it, and then rally off of it. That's what's going to happen today. We came back yesterday, closed right at the 50-day moving average. Stocks held right there. This morning, stocks going to be up about 1.5% or so, coming very sharply off of that 50-day moving average. So a good reflexive rally, a good retest of that 50-day, establishing that 50-day moving average now as support rather than resistance is what we had previously. So that's actually a very bullish sign for the markets. Now, if we can break above about 39.10 on the S&P, then that's going to help elevate the markets up here towards potentially 40.50 to 4100. That'll kind of be the next set of resistance levels that we're going to get to. So again, this rally today could certainly set the tone for a little bit more of a bullish trade here in the markets near term. Again, MACD buy signal continues to be on a buy signal. That's been supportive of asset prices. Got a little bit of that overbought condition worked off, but still overbought here, but not as bad. So again, that kind of lets some of the pressure off this market in this terms of this recent rally. And now we've got this potential here for the markets to move up a bit more and just really kind of continuing this kind of positive trend that we've been building over the course of the last 3-4 weeks. Have been building this nice little positive uptrend in the markets. Now, it's not aggressive. And we've talked about this a little bit yesterday. It hasn't been an aggressive move higher. It's been this kind of slow grind. Now, in a way, that's not great because that kind of slow grind is eating up a lot of that buying power that was sitting there in the markets. And that does potentially put the market at risk for another downturn to potentially test these recent bottoms. We'll see if that happens. Now, the other big news today, of course, is that 2 o'clock, we're going to hear from the Federal Reserve. Next interest rate hike coming out today. Of course, it's widely expected they're going to hike 75 basis points. That's not the big surprise. What potentially could, roil the markets here a bit today is if they come out to be more aggressive in their stance towards inflation. And there's been some talk here recently, by Fed officials that, they are solely focused on fighting inflation. Now, they're starting to get some heat from Elizabeth Warren and others up in Congress, really kind of pointing the finger at the Federal Reserve, saying this whole problem in the economy, it's all the Fed. They did it all. We had nothing to do with it. It's all the Fed. Again, while the Fed's not supposed to be political, we know from past experience that they tend to kind of bend to the will of the administration a little bit more than not. So the question will be today is whether or not the Fed starts to kind of drop that hint of a pivot. Are they going to kind of back off having such a strong inflationary fighting stance and start to talk about, well, we're going to kind of wait and see, this is, going into the midterm election cycle, are they going to try to pull back to help support the markets? This is going to be the big question. So whatever comes out of that conference this afternoon, so that'll be at about 2 o'clock this afternoon, Central Time, that could potentially move markets one way or the other. Again, if they come out extremely strong about fighting inflation, that could pull some of this, the steam out of the markets. Again, tighter monetary policy, slower economic growth, that's going to weigh on earnings. So maybe we haven't priced in all the earnings degradation just yet in stocks. That could weigh on markets. If they come out a little bit softer in their inflationary fighting stance, could help rally the markets. I don't really expect a lot of fireworks today. Wouldn't be surprising to see the Fed just come out, pretty much stick to their guns and not change anything from what they said over the last couple of weeks. Certainly another possibility. And markets may play with that okay. Again, so, the important thing here, though, is markets are starting to bounce off, these kind of support levels. And that's helping, provide some stability to the markets, helping, set markets up now for a potential for a little bit more rally as we get into mid-year. Now, again, this is July. Typically one of the stronger months of the year. So, not surprising that this market's been performing a little bit better this month, and particularly coming out of May and June, which were really, really weak months. Not surprising to see a little bit of positive action in markets. August, September tend to be a little bit weaker. So again, as we get through this month, and again, starting on Monday, Tuesday next week, we're going to be starting to talk about the month of August. What does that mean for stocks and what does that mean for portfolios? That's going to be a whole different ballgame when we get there. Again, one hurdle at a time. Federal Reserve today. Tomorrow, we get the first estimate of second quarter GDP. Atlanta Fed says it'll be negative, but a lot of economists currently still pinning in a positive rate of return for second quarter GDP growth. Goldman Sachs out today with a 0.5% growth rate for the second quarter and increasing rates of growth for the economy in every quarter after this. Goldman Sachs sees no recession on the horizon for the economy. Will they be right? The first estimate tends to be kind of a consensus of Main Street economists. So again, could be on Thursday. We see a positive number, 0 to slightly better for the economy for the second quarter. Technically, that'll keep the recession call at bay temporarily. That may also help boost stocks in the short term. All right, lots of stuff to get into today. It is Wednesday, of course, so stick around. More of the Real Investment Show coming up right after the break.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
Inflation touches every aspect of your life. No one can avoid it because we're living in an inflation nation. RIA Advisors has a 9-step inflation battle plan, and we're sharing it with you in a special summer lunch and learn, Thursday, August 4th at noon. Register now at realinvestmentadvice.com. There's no magic elixir against inflation. Our 9-step plan can help you blunt inflation's effects. Register today at realinvestmentadvice.com. realinvestmentadvice.com.
Health and financial security touches everyone within your organization. Offering benefits for all doesn't need to be complicated. Hi, I'm Tom Allen, Senior Benefits Consultant at RIA Advisors. RIA Benefits provides independent expertise to find solutions that speak to the mission of your business, the culture you want to establish, and the budget you are able to work within. Book a free consultation with me at realinvestmentadvice.com/retirement, and we'll find a solution that takes care of your most important asset, your people. realinvestmentadvice.com/retirement, realinvestmentadvice.com.
Could your job still be at risk? A new normal can still include new obstacles. A severance package can be an emotional as well as a financial decision to consider. Wouldn't it be comforting to review the options for you and your family with an objective financial partner? At RIA Advisors, we're here to help. From severance pay, tax timing decisions, to how to maximize unemployment benefits, the RIA team wants to make sure you can do what's best for your family. There's no charge for a consultation, so reach out to RIA Advisors, 855-RIA-PLAN, RIAadvisors.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
The Real Investment Show.
It's kind of an interesting situation that we're in right now. The Fed's trying to raise interest rates, and for the first time now, there used to be back in the day, a couple of years ago, the whole kind of investing mantra for the markets was TINA, which is there is no alternative to stocks, right? And so this was because interest rates were low, and because interest rates were low, then, you really had to chase risk because you couldn't get a return on anything else, right? If you had money in a money market account, it yielded 0. So you were making no money on your money, having it in places of safety, right? Now, all of a sudden, you kind of wake up and stocks are down about 20, 15, 16% for the year now, 17%. And there is an alternative. You can buy a 1-year treasury bill right now, have no risk to your money. Your money's going to come back to you in 12 months, and you're going to get about 3% on your money. And that's about as good of a guarantee as you're going to get. We call Treasury bonds risk-free rates of return because in the worlds of guarantees, right? If there's and again in the investment world, you can't ever promise a guarantee, right? You can't say that you're guaranteed to get this back. But you're as close to a guarantee as possible with a U.S. Treasury bill because the government is promising to pay you back. And that's why we call, Treasury rates risk-free rates. So when we're looking for risk-free rates of return, we look at Treasury bills. Everything else has risk to it. Corporate bonds, muni bonds, et cetera, all have risk, right? Defaults, et cetera. It's expected that the government will always pay its debt because they can print money, right? So as long as they've got the government printing press running and they've got paper and ink, well, they can pay their bills when they come due. So this is one of the, kind of conundrums is that now here it is for the first time, there's an alternative. But yet, as investors, we're all wanting what? We want the Fed to cut rates back to zero, right? Because we want stocks to go up. We want cheaper rates. Interesting headline today, mortgage rates decline, mortgage applications decline further even as mortgage rates drop. So just recently, there's been a drop in the 10-year Treasury rate as yields are starting to try to price in inflation or a peak of inflation and more deflationary pressures and slower economic growth. So yields have dropped here a bit. So even though the mortgage rate has come down a bit, mortgage applications are still declining. And that's because prices are too high. And mortgage rates, despite this little small downtick as of late, are still much more elevated than they were a couple of years ago. So in the housing market, it's very psychological on two different fronts when it comes to mortgages, right? So first of all, I'm not going to refi my mortgage. If I'm currently have a mortgage rate of 3%, on my mortgage, I'm not going to refi at 4.5%. That just makes no sense to raise my monthly house note for one reason or the other. Unless I just need to have cash out of my house for one reason or the other. So, if you're trying to cash out, refi your house, then, maybe you'll go ahead and refi up at a higher rate if you actually just need the cash for something to do. But most people are going to sit there and go, well, my mortgage rate is 3. I'm not going to refi at 4. So mortgage refis drop very sharply. New mortgage applications also drop because psychologically two things happen with the housing market. First of all, people going out to buy a house say, well, mortgage rates were a lot cheaper a couple of months ago. I'll just wait and see if mortgage rates come back down again, and then I'll go buy a house. I'm not in the absolute rush to go buy a brand new house right now. Now, there's always going to be transactions in the housing market, always. Doesn't matter what rates are. Rates could go to 10% and there'll still be somebody out there buying a house because they have to. They're getting transferred. They're moving somewhere. They have to move somewhere for some reason or the other. And there's always going to be a transaction in the real estate market somewhere. There's always a buyer. There's always a seller. It'll always happen. It may not happen very rapidly, but there's always transactions that go on. However, there is a psychological component to this that affects people two ways. One is that, people tend to work on, again, and we've talked about this before, when people go to buy houses, they don't buy a house. I don't go out and buy a house. I buy a payment, right? And so I go look at a house and I go, wow, this house is great. It's wonderful. And I can get this for the low monthly down payment of $600 a month, whatever it is. And that fits in my budget, right? I can afford $600 a month. At $800 a month, I can't really afford that. And so when mortgage rates go up, two things happen with buyers. One, they know rates were low, and there's been a long history of declining interest rates. So most buyers are now aware that even though rates may pop up temporarily, they'll go back down again. So they may wait to make a purchase. The other side of it is they can't afford to make the purchase. And this is why we see housing activity slowing down. So what does this have to do with what I'm getting to here? Low rates. This is what we all need, right? We are a debt-driven society, and everything we're doing is based upon debt in some shape, form, or fashion. So while we complain a bit about the Tina effect, in other words, the Federal Reserve forcing individuals into high-risk equities because they can't get a return on savings, it's also a function of economic demand. We just simply can't afford to have higher rates because everything we do is in debt, whether, as we've talked about here recently, surging credit card debt to make ends meet, right? That's some of your highest rate debt, and those rates are going higher. Variable rate debt's going up as the Fed hikes interest rates. Variable rate debt goes higher. Again, higher payments means more of my money going to service debt than to spend on other things, right? So this all acts to slow the economy, but there's another, kind of dark side to all of this, and we don't talk about this enough. And when I say this, you're going to go, that doesn't make any sense. But higher rates are actually good for you. We should be happy the Fed is hiking rates. We should be happy that the 10-year Treasury rate is at 3% or more. And we should want the 10-year Treasury rate, say, at 5 to 6%. We should want that. Now, that's hard to fathom because we've been in such a long, multi-decade trend of lower rates, but we should want higher rates. And here's why. First of all, if I'm loaning money out in the world, so I'm a lender, I should want higher rates, right? Because I have to loan money and I take on risk to loaning Brent money, right? I'm going to loan Brent money for 30 years to go buy a mortgage. I should want a rate of return that gives me at least inflation plus over time. So if inflation runs at 2.5% historically, I need to make that inflation adjusted rate of return over 30 years plus a little bit more. Right? I need to make some money, right? I need to be profitable. So all of a sudden at 4 or 5% interest rates, I'm going to be much more inclined to loan money because now I can loan money for a longer period of time and make a decent rate of return. So that's one thing. So that pushes more money into actual economic development. What we've seen over the last couple of decades is nobody really wants to loan money to the average person because there's too much risk and there's, too little return. And so a lot of this Fed monetary policy, what QE was supposed to do was give banks reserves. They were supposed to loan that to the economy and to people in the economy, and that helps economic growth, right? Because I loan Brent money, Brent goes out and starts a business or he builds a house or whatever, and that creates economic activity. But there was no reason to loan Brent money when I could take that same amount of money and invest it through my prop trading desk and trade securities and make a lot more money with less risk than loaning money to Brent for 30 years at 2%, 3%, whatever the number is. So higher rates actually work to push money into economic development because the lender can get a return. Now, what about the other side of this? Well, as savers, now all of a sudden I have an incentive to save money in safer vehicles because I can actually get a rate of return. If I could tell, it's interesting because we meet with a lot of individuals here, every day in our shop. And, it's interesting that the average conversation goes, if I can just get 4 to 5% a year on my money, I'm great. That's all I need. I don't need to take a bunch of risk. If I got 4 to 5%, I'm good. I can meet my goals. And that's true. Back in 2000, I could not sell CDs to individuals in late 1999, early 2000, because everybody was chasing stocks at that time. And these CDs were yielding 8%. Now, if I could tell you that you could have an 8% FDIC insured return on your money today, how many of you would raise your hand and go, yeah, give me that? Rule of 72 says, if I can get 8% a year on my money, Rule of 72 says I double my money every 9 years. So this is the idea, right? When we come back from the break, we'll talk about the dark side of what low interest rates are doing to you and the economy. Because there's an interesting conundrum here because, we're all hoping the Fed is going to pivot and start dropping interest rates back to zero so stocks will go up. But we're actually asking for something that's detrimental to our long-term outcomes. Be right back after the break.
Step into the confusion. Can't you hear the sound that's in the air?
It's rock and roll. 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 It's rock and roll.
The Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
Inflation touches every aspect of your life. No one can avoid it because we're living in an inflation nation. RIA Advisors has a 9-step inflation battle plan, and we're sharing it with you in a special summer lunch and learn Thursday, August 4th at noon. Register now at realinvestmentadvice.com. There's no magic elixir against inflation. Our 9-step plan can help you blunt inflation's effects. Register today at realinvestmentadvice.com. Realinvestmentadvice.com.
Health and financial security touches everyone within your organization. Offering benefits for all doesn't need to be complicated. Hi, I'm Tom Allen, Senior Benefits Consultant at RIA Advisors. RIA Benefits provides independent expertise to find solutions that speak to the mission of your business, the culture you want to establish, and the budget you are able to work within. Book a free consultation with me at realinvestmentadvice.com/retirement, and we'll find a solution that takes care of your most important asset, your people. realinvestmentadvice.com/retirement, realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. A passive investment portfolio requires active risk management. It's not a choice, it's necessity. Diversification doesn't protect against risk of loss. Let us actively help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
So my daughter moved out of the house yesterday. I think she's going to be president.
How's that?
She's moving out, and we're trying to move our house. And so I told my son and daughter, I said, look, before y'all leave the house, I want all this stuff moved out to the garage. And they're like, okay.
The Real Investment Show podcast.
In about 30 minutes, she comes back with like 4 friends. She suckered these 4 other kids into moving all the trash out to the garage while she stood there directing.
At realinvestmentadvice.com.
She's going to dominate the world.
Anyone can sell you insurance, and they'll gladly take your premium dollars. The RIA Insurance Agency can provide you with insurance solutions tailor-made for your needs and lifestyle. Because everyone's assets are different, let RIA Insurance review what you need to protect and how. We won't sell you insurance, but what you need will be a matter of policy. RIA Insurance Agency. 888-915-0780. 888-915-0780. RealInvestmentAdvice.com. Click on the insurance tab.
Real Investment Show podcasts are now available from Stitcher Smart Radio at Stitcher.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets. And unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA Advisors to work for you managing your 401k plan. It's a quick and easy application. Just simply click Ask a Question at realinvestmentadvice.com or give us a call at 855-RIA-PLAN. That's realinvestmentadvice.com.
Have market gyrations caused you to lose sleep? If so, it's because you have more risk in your portfolio than you realize. It's time to reevaluate your long-term investing strategy with RIA Advisors. Our disciplined approach can help eliminate unnecessary risk. If you think it's time to work with an advisor who puts your interests first, it's time for Real Investment Advice. RIAadvisors.com.
You're listening to The Real Investment Show.
And welcome back to the show this morning. So talking a little bit about low interest rates. And we all want them, right? We all want lower rates because it makes things cheaper, right? I can buy a house for a lower monthly payment, buy a car for less. We all like low interest rates. And we like low interest rates because it makes stock prices go up, at least in theory, right? So if I have a zero rate of return on fixed income, then why do I want on fixed income? I'll buy stocks, and that pushes money into equities, and people take on more risk, right? Makes complete sense. And now, because we've gotten used to that, that's what we kind of argue for. And, this is what we're talking about today with the Federal Reserve. The Federal Reserve will come out today, hike rates by 75 basis points, probably open the door to another 75 basis point hike in September, which could spook the markets a little bit because that's a little bit more aggressive than the markets are expecting. But we should actually be applauding higher interest rates. And I, like as I said in the last segment, I know that seems weird, right? But there's a benefit to higher interest rates. And one of the things that we have done over the course of the last decade, really 2, 3, 4 decades, is that we've had this consistent bend into driving interest rates lower. The Federal Reserve, every time there's a hiccup in the markets or there's a recession, and this goes back to 1980, the Federal Reserve lowers interest rates, well, to combat that, and that's great. So that pulls down interest rates across the board, and people start buying stuff again, as they should. But then the Fed starts hiking rates, but we never hike rates higher than they were before, and as a function of that, people were still leveraging up more debt, taking on more debt. That diverts more debt from economic growth, and as a consequence, we've had slower rates of economic growth over time. And a byproduct or a contributor to that is, of course, lower interest rates, which increase the amount of debt that people use to make ends meet. The more debt we have, the slower the economic growth is. And there's a high correlation between economic growth, inflation, interest rates, et cetera, over time. And we all know that the consequences of debt, but yet we root for lower interest rates because, well, it just allows us to take on more debt, right? I can take on more debt as long as my payment doesn't change. And lower interest rates will do that for me. But low interest rates also have an economic issue to them. And again, we should be rooting for higher interest rates. We should be wanting higher interest rates. Because if we have higher interest rates, we'll have higher economic growth. Now, not immediately, right? So if interest rates went to 5%, 6% today, we'd have a terrible recession, right? It'd just lock everything up because we have so much debt. But if we actually allowed a recession to occur, and if we actually allowed the debt cleansing process to occur where we reduce that debt on the books through default, bankruptcies, whatever, right? The economy will begin to revert itself, right? And we'll start to move back towards being a bit more prudent about how we manage our money because, again, the cost of debt is higher, so now I can't take on as much. Now, importantly here, this would, over time, allow for the economy to begin growing faster, again, because higher interest rates will now attract capital into the actual economy. A lot of these zombie companies that depend on low interest rates in order to refinance debt at low rates to pay their debt, they're going to go out of business, right? So that's going to cleanse a lot of these zombie companies out of the economy and allow new business entrants to come in to take those spots, right? Brent has a zombie company that manufactures widgets, as an example, right? And he's manufacturing widgets and he's taking up space in the economy. And the way he keeps his business running, he keeps issuing out low interest debt, and so he can pay his shareholders and pay his interest payments, pay his debt, right? And so he's taking up space, though. And in his widget company that he makes, right, I could go in and compete with him, but he's taking up that space. Now, if we raise interest rates to the point that he can't refinance his debt, right, he goes out of business. Now, all of a sudden, that space is open for somebody else to come in and fill that space with a more profitable company, create more jobs, do a better job at running the company, etc. Higher rates will do that. And this is the problem. So when you have low interest rates and you have negative real interest rates, which we have right now, you have this false sense of solvency and security that everything is okay. And, this allows for us to run, because of low interest rates, we can run higher valuations in equities, right? We can overpay for companies. And that's been the argument much for the last couple of years, is that, well, because interest rates are so low, we can pay higher valuations. And so basically you're overpaying for a company that doesn't make any money. Yeah. And you justify that by saying there is no alternative to investing capital in the equity market. So I'm going to take on this excess risk because I can't make anything out of fixed income, which is safe. But yeah, we all want lower interest rates. We all want lower interest rates, even though it has a negative impact on economic growth, financial stability, and economic prosperity over time. But see, these are the decisions that we make. And we make these decisions across the board. We make decisions politically based upon expediency of what makes people feel better right now, rather than what makes people feel better over the long term, right? All these people right now, begging for socialism because socialism gives me free stuff. The long-term economic impacts of that are terrible. But I'm hurting right now, so please do something for me right now. It's surprising. The entire economic consensus recognizes that the rate cuts in the early 2000s led to repeated bubbles in the markets. We had the dot-com crash, then we had the financial real estate related crash because of low interest rates, subprime mortgages, all that. Now we've got one of the biggest asset bubbles ever in the history of the world that we have not deflated by any stretch of the imagination. We have it in housing and debt and equities and everything all at once, right? We have multiple bubbles, financially speaking, because of negative interest rates, negative to low to negative interest rates, and not just domestically, but globally. And as I talked about yesterday, because of these low interest rates and all this monetary intervention, all these fiscal, policies that we've done, we've elevated stock returns 4 full percentage points on average above their long-term average going back to 1900. It's unsustainable. The markets can't grow faster than the economy over time without low to negative interest rates. But again, you have this very negative impact because of that in the economy. You have repeated bubbles and busts. You have people lose money on the equity side. You can't make any money in safe investments, so people shun those to take on more risk, which winds up negative impacting their financial wealth over time. And what we wind up with is a bigger wealth gap, because those at the top of the ladder that own 90% of the stock market, they've got enough wealth. If the market goes down, it doesn't really impact their lifestyle much. But for everybody else, that bottom 90%, real changes to real wealth mean a lot, considering that most of them don't have more than a year's worth of salary saved up to start with for retirement. And they're all focusing on having Social Security to collect from. And as we just wrote on our website here just recently, that's a $96 trillion graveyard that's sitting there that isn't going to get fixed, because all politicians can figure out how to do is to put more people on the rolls of Social Security, and fewer people are paying into it. So these are problems. And it's surprising that as politicians and as individuals and as, the media, we're all begging right now for lower interest rates. We're all watching the Fed go, oh my gosh, they're going to hike 75 basis points. What if they hike another 75 basis points in September? That could be terrible, right? We need lower interest rates. Got to get the economy going in. Well, this is akin to life support. And this is what we've been doing for the last 30 years. We've got a patient, he's on life support. Every time you try to take the patient off life support, he starts to crash again. So you got to put him right back on life support, keep him alive. The problem is we've got an economy that doesn't have a do not resuscitate order in place, right? So, we keep trying to resuscitate an economy that needs to be allowed to expire so it can grow again. I know that sounds counterintuitive, but we didn't get into this level of debt and deficits and financial engineering, et cetera, overnight. We're not going to get out of it overnight, and we can't get out of it pain-free. We all want to fix the problem. Everybody's nodding their head. Yeah, we got a debt problem. We need to budget, right? We need to have a budget in Washington. Need to cut spending, reduce the debt. Yeah, sounds great. And as soon as we elect people to go to Washington, what's the first thing they do? They run up more debt. Why? Because it's expedient. It's easy to get you voted, to get you elected. Nobody really wants to go through the effort to create long-term economic prosperity and economic wealth for everyone, because the amount of pain you got to go through in the short term would be well worth it long term, right? But we just don't want to do that. All right, quick break. We'll come back. Wrap up the show as the markets get ready to open. Futures pointing nicely higher this morning. Out of the gate, we'll talk a little bit more about that. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
Inflation touches every aspect of your life. No one can avoid it because we're living in an inflation nation. RIA Advisors has a 9-step inflation battle plan, and we're sharing it with you in a special summer lunch and learn Thursday, August 4th at noon. Register now at realinvestmentadvice.com. There's no magic elixir against inflation. Our 9-step plan can help you blunt inflation's effects. Register today at realinvestmentadvice.com. realinvestmentadvice.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets, and unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA Advisors to work for you managing your 401k plan. Get started right now at the website, realinvestmentadvice.com, or simply call our toll-free number, 855-RIA-PLAN at realinvestmentadvice.com.
Health and financial security touches everyone within your organization. Offering benefits for all doesn't need to be complicated. Hi, I'm Tom Allen, Senior Benefits Consultant at RIA Advisors. RIA Benefits provides independent expertise to find solutions that speak to the mission of your business, the culture you want to establish, and the budget you are able to work within. Book a free consultation with me at realinvestmentadvice.com/retirement, and we'll find a solution that takes care of your most important asset, your people. realinvestmentadvice.com/retirement, realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
The Real Investment Show.
And welcome back to the show this morning. So, as I said earlier, Federal Reserve, of course, is going to hike interest rates today. Question is only really not what they do today, but really what their outlook is. And again, while, as we were talking about in the last couple of segments, while we all kind of want lower interest rates because it allows for us to buy more, do more, etc., and certainly help stock prices. So if your whole focus is the stock market and you just want stock prices to go up, lower interest rates will certainly do that for you. I mean, this is the whole thing everybody's looking for right now is like, when's the Fed going to pivot back to QE, right? Get back to increasing that balance sheet and, lower those interest rates to zero because that makes stocks go up. And we've trained people to do this for like 12 years now. And that's really kind of part of the hope here and part of the rally this morning is that maybe the Fed, this kind of whisper, right? Maybe the Fed will pivot, right? Maybe they'll talk about slowing the rates down. Kind of a pause, right? To wait and see, a kind of a wait and see approach to the economy. Again, as we were saying in the last segment, it's not that great for us, right? I mean, we want, what we're asking for is not great for us. It's kind of like we talk a lot on the show about health and diet and exercise, and the reason is nobody wants to do that, right? Nobody wants to go work out. It's just not fun. But if the alternative is that we cannot do that, we cannot take care of ourselves, we cannot exercise, we cannot eat right, not go see our doctors, and then we'll spend $350,000 in retirement and be in and out of hospitals a whole lot. And that's not really a great way to spend your retirement money, or your retirement is being in and out of hospitals and being unhealthy. I mean, that's not what we hope for. It's always interesting, when you watch television, all these financial advisory companies, they show an old couple on the beach or sitting on their boat or whatever, and they're enjoying their retirement. It's great. They don't show the guy that's pretty overweight, laying in a hospital bed, on resuscitation, yes, UBS, it's you and us, and you want to spend a retirement? We're there for you, right? Nobody ever shows you that, right? Because that's not gonna sell advice. But that's what, unfortunately, this is what a vast majority of Americans are looking forward to in retirement, because we haven't taken care of ourselves. And this is the same thing with the economy, though, right? We keep saying, look, we can just eat cupcakes every day. And it's fine. It's not hurting me right now. Sure, I gained a little bit of weight eating cupcakes every day. But long term, it has very negative consequences. And so we keep wanting, the Federal Reserve and the government to keep giving us cupcakes every day. And it's great because, we like cupcakes. But we also inherently know that if we eat cupcakes all day long every day, that there is a negative outcome for that, right? We all inherently know that, but, we want to ignore it. And it always fascinates me. It's like, if you talk about, there's always the guy, right? When you're having a conversation with somebody, it's like you're saying, smoking's bad for you. My uncle smoked for 80 years and never got cancer, right? There's always that guy, right? My dad ate cupcakes for 50 years and never gained an ounce. Okay, there's always one guy, right? So, but you get the point, right? We know that scientifically not taking care of ourselves leads to negative outcomes. We also know economically that the choices that we're making are not great for us financially long term, but we do it because we like it right now. I can't tell you how many people I visit with that, they're approaching retirement pretty quick, haven't saved a penny, and now they're getting serious. Now it's time to get, they're 5 years from retirement. Now I want to start saving for retirement. How do I get from $0 to $1 million in 5 years? To get from $0 to $1 million in 5 years, you're going to need to save $250,000 a year. I mean, that's how you get there. You can't make up for the lost time. And the choices that we're making are eating up that time that we have. And again, we don't care about this stuff in the short term. All we want right now is we want lower interest rates, because lower interest rates will get our stock prices to go up, and then that will help us get towards our financial goals. That's awesome. But we don't really recognize the long-term economic consequences that we're building into our system. And it's not just for us, right? It's interesting. We're all focused on climate change, right? Got to get rid of CO2 emissions, because CO2 emissions and greenhouse gases are destroying the climate. We're all going to die. Look, we live on a dynamic planet. There's no evidence that one factor alone is creating climate change. But that's the one we chose to focus on, right? So if you want to get rid of CO2, right, just wipe out half the human population, and you solve your climate change problem pretty quick, right? We don't want to do that, right? We want to figure out every other thing we can do not to do that. And it's kind of the same thing with the markets. We're trying to figure out every other way possible to try to get to where we want to go without attacking the one thing that is the problem. because we don't like that. And so this is just, this is the part that we have to consider. Now, markets are going to be up today. And as we talked about, at the beginning of the show, this is actually a continuation of this bit more optimistic look at where we are in the trend right now, right? Over the last 3-4 weeks, the markets have been rallying fairly nicely. We've been talking about it here on the show, talking about, if we can break above, the downtrend, that's bullish, and we can get above the 50-day moving average, that's better. We did that. Talked about we needed a retest of the 50-day moving average and the market to hold that level of support. Well, we tested that 50-day moving average yesterday. If the market can hold this rally today, we'll have a good, successful retest of that previous resistance, turning it into support. These are all good bullish things, right? Short term suggest higher prices. There's going to be a lot of talk now in the media talking about, is the bottom in, right? Markets are suggesting that we're going to avoid a recession now because stocks are clearly pointing to the upside and stocks that are missing, Microsoft and Google today missed earnings revenues yesterday, and stocks are trading up nicely this morning, suggesting that a lot of that bad data, kind of the negativity, has now all been priced into stocks. Now, I don't know if that's the case or not. The action is bullish, no doubt about it. And we need to pay attention to that. But there's a lot of economic data that says, well, maybe things aren't getting better just yet. There's some indications out there that we're not yet, through whatever this economic cycle is that we're in. Consumer confidence yesterday declined a bit more as consumers are more concerned about higher interest rates. Now, again, the Fed's going to hike interest rates today. That's going to tighten that monetary policy even more. So the concerns that consumers are showing through not only their confidence surveys, but also their actions, right? Again, Walmart yesterday talking about slower retail traffic. It was interesting this morning. I posted a graphic on my Twitter page. And it basically ranks the world's largest retailers. And there was a graphic that Brent had given me this morning. Walmart, Amazon, Costco, Kroger's, etc. These are the world's largest retailers. Walmart is twice as large as Amazon. And that's kind of hard to believe because if you kind of look around the world, everybody's like Amazon, Amazon, Amazon. My wife, everything she buys is from Amazon. Walmart dwarfs them. So if Walmart is seeing slower retail foot traffic in their stores, that has, and I posted this graphic this morning, and a guy, tweeted me back. He's like, well, this is an inventory management problem, and you should blame management for that. Slower retail foot traffic is not an inventory problem, right? That's people having less money to spend, and that's what's happening. And we're seeing that across the board. And we're likely going to see that through a lot of more of these reports. Amazon is set to report, I believe, next week. So it'll be interesting to see what they say about their ordering traffic. Now, they just had a really big Prime Day. Amazon did. But they had to discount items heavily to generate those sales. They had like up to 89% off on a television. So, you're talking about really slashing prices to move inventory. And so, but that is a function of consumption. And, we're still seeing evidence that the economy is getting weaker as the Fed continues to hike interest rates, which is exactly what the Fed wants, right? They're hiking interest rates in order to slow economic growth, which will bring down those inflationary pressures that will cause lower prices because of less demand. So have stocks actually priced in the bottom of the market? It's hard, right? It's hard to say that is a fact because we're still seeing more economic weakness coming. But markets tend to predict and begin to adjust for turns in that data. So we can't discount the market entirely and say the market's wrong, right? The market's clearly suggesting something here. The question is do they have it right? Are they early? Or Is this just a reflexive rally and a continuation of a bear market? Unfortunately, there is no clear answer, and we won't know. What we have to do is we have to navigate the market for what it is, understand what the market is right now, and make adjustments accordingly. We'll see what happens today. We need to make sure and hold this rally through the rest of this week. Again, as I said before, the retest of the 50-day is fine. The bounce off of it is fine. We've got to hold it through the end of the week. So if the market's going to hold above the 50-day moving average through Friday, that's a much more bullish setup for stocks, at least in the short term. All right, that wraps up the show for the day. 3 minutes on markets and money coming right up. Get by the website. Check out our latest blog post by Michael Leibowitz talking about inflation or recession. That's on the website now at realinvestmentadvice.com. See you back here tomorrow.
All the things I could do if I had a little money. It's a rich man's world. It's a rich